Up to this point, we focused on either a single lump sum or cash flows that are consistent in both amount and timing, along with examples where we combine the two. So let's begin this discussion with that familiar setup. Suppose we can purchase an investment that pays $50,000 at the end of each year for 10 years. Over the life of the investment, that totals $500,000 in nominal cash flows. This represents an ordinary annuity, and if we require a 5% annual return, we can calculate its present value using the techniques we've already learned. First, we could use a factor table. The present value factor for an ordinary annuity at 5% for 10 periods is 7.72173. Multiplying $50,000 by this factor gives us a present value of $386,086.50. So that's the amount we'd be willing to pay to earn a 5% annual return. Because the cash flows are consistent, we can also use Excel's present value function. Using a 5% rate, 10 periods, and entering the $50,000 payment with the opposite sign to reflect the cash outflow versus inflow, Excel calculates a present value of $386,086.75. The small difference from the factor table result is simply due to rounding. But what if we change the cash flows? Not the timing, but the amount received each year. Suppose we're evaluating a potential business acquisition and estimate the business will generate uneven annual cash flows in the pattern seen here over the next 10 years, totaling $583,450 in nominal terms. We again need to calculate the present value of this stream of cash flows. But now we have a complication. There are no factor tables for an arbitrary stream of cash flows, and standard time value of money calculators assume a constant payment. Excel's present value function requires a single payment amount per period, but in this case the payments vary from year to year. Now we've already seen the technique needed to solve this. For an inconsistent stream of cash flows, the most practical approach is to use a spreadsheet and treat each cash flow as a separate single lump sum. So to calculate the present value, assuming a 5% annual return, we simply add a present value column and discount each year's cash flow individually. Each present value is calculated as the nominal cash flow divided by 1 plus the 5% rate raised to the number of years until that cash flow occurs. And if we sum the individually discounted cash flows, we calculate a present value of $444,904.03. Excel also provides a built-in net present value function that performs the same calculation in one step, using equals NPV with a 5% rate and referencing the stream of annual cash flows, produces the same $444,904.03 result. Just keep in mind that Excel's net present value function assumes the first cash flow occurs at the end of the first period, which matches our setup here. So if we believe this business will generate the projected cash flows and we require a 5% annual return, we'd be willing to pay $444,904 today. That price reflects the present value of $583,450 in this stream of projected nominal cash flows over the next 10 years. And while a 5% return may be low for this type of investment, it works for illustration purposes. So again, there is no new technique here. We're simply treating each individual cash flow as a single lump sum and discounting them back to today based on how far in the future they will occur. And we're using the power of a spreadsheet software to do it very efficiently. And this is a simplified example of a discounted cash flow analysis. The full discounted cash flow model we'll build later in the series will include additional assumptions and inputs, but the underlying time value of money mechanics remain the same. But before we build our full discounted cash flow model, we need to briefly revisit interest rates. To this point, we've focused on the mechanics of discounting, but the choice of discount rate is just as important as the calculation itself. You'll recall that I just mentioned how a 5% return for the business acquisition example might be a bit low. And that begs the question, what exactly does our discount rate represent, and how would we go about determining it? It's an important question because even small changes in the required return can significantly affect valuation. So in the next episode, we'll explore what these rates represent and how an appropriate discount rate might be determined.